Welcome to Cherry Bekaert's Private Client Service podcast, where we discuss tax, accounting, and business matters impacting your business and personal growth goals to help guide you forward to achieve your financial objectives. I am Mike Kirkman. I'm a partner with Cherry Bekaert, and I lead our firm's estate, gift, and trust practice. Today with me is Deb Walker, our firm's national leader of comp and benefits. Today, we're discussing incentive plans and how businesses retain and keep talent. Deb, I really appreciate you joining me today, so let's just jump right in on it. So, Deb, considering so many industries are experiencing labor needs and shortages, what effective arrangements have you seen that help attract and keep key personnel?
So I think the most effective are performance annual bonuses, and that's beneficial, of course, for management because they're rewarding people who have met specific performance goals and performance goals that are understood by everybody, and then paid out because they've met the performance or not paid out if performance wasn't met. There can also be equity-like goals or equity-like plans or equity plans. But in private industry, we don't see as many equity plans because of a desire to control stock ownership. And we see equity-like plans, which is a payment of compensation equal to the growth in equity. That also has some issues with private companies because you have to then value the equity. So I would say performance pay plans are the best way to go.
So what are some of the more straightforward ways that business owners incentivize and retain employees that you've seen over your experience?
So I think these performance plans can be annual plans and they can be longer term incentive plans. So or a combination of both. Usually the higher level of the employee, the more likely you are to see long-term plans because you want your executives to focus on long-term growth as opposed to short-term growth. And at the lower levels, you see maybe even quarterly plans as to the work that was supposed to have been done during that quarter. And of course, before you even get to salary, quickly after salary, you want to make sure you've got all the right fringe benefits. So 401k plans, Congress just recently passed some rules regarding starter 401k plans. They've increased the credit for starting retirement plans. They've made the plans easier to start. You can start them after the end of the year. So you want to make sure you have the right retirement plan benefits and health benefits, even if you don't pay for the health benefits. If you provide the opportunity to join a group plan, which is usually cheaper than an individual plan, and let the employees reduce their salary on a tax-preferred basis to have that health benefits plan.
That's great. Are there plans, Deb, that allow key employees to own stock or an interest in a business like an LLC?
Yes, so that's interesting you mentioned an LLC because LLCs are often taxed as partnerships. And at a partnership level, you can grant what's called a profits interest. And a profits interest gives the individual rights to be a partner after certain hurdles have been met. So you're not transferring anything that already exists as value within the partnership. You're transferring future value. Now, and in IRS's position is that a profits interest on the date that it's transferred to the employee has no liquidation value, and therefore nothing is taxable. It will be taxable as that profits interest vests and those hurdles have been met and distributions are made. If you are in an LLC taxed as a partnership and get a profits interest, you are required to be treated as a partner, even though the allocation for a partner may only be a zero amount. You would have your salary reported to you as a guaranteed payment. So the moving away, well, let's stay with the partnership for a while. You can get a profits interest that I just explained, or you can get a capital interest. A capital interest transfers equity in the value of the partnership to you, and that's going to be taxed to you just as if you were transferred stock. So within the corporate arena, you can be transferred stock, you can be transferred an option, which is the right to buy stock at a fixed price for a stated period of time, or you can be transferred a stock appreciation right. A stock appreciation right is the right whenever you want. By exercising that right, you get the spread between the value of the stock on the date that you exercise and a base amount, which should be at least equal to the value of the stock on the date that the SAR or stock appreciation right was granted to you. So generally, when you get any equity, whether it's equity because the employer gave you stock, whether you exercised an option and got stock, whether you get a capital interest in a partnership, you're going to be taxed on the value of that interest that you get minus whatever you pay for it. And the point of taxation is going to be when there is no longer a substantial risk of forfeiture. A substantial risk of forfeiture exists if you have to meet certain performance goals or you have to meet service requirements, such as if you work for me 3 years, then this stock becomes yours free and clear. Now, if you get something stock, which would otherwise be taxable on the value of the stock minus what you pay, and it has risk of forfeitures in it, then you get to choose. Do you want to pay tax on the date that you get the stock, even though it's subject to a risk of forfeiture, or do you want to pay tax when the risk of forfeiture lapses? If you do nothing, you will pay tax when the risk of forfeiture lapses. If you make what's called an 83B election, you will pay tax on the date of transfer. So let me give you an example. Let's say I'm going to transfer shares of stock to you. Today they're worth 10. And I say, but you have to work for me 3 years before those are yours free and clear. Okay? You decide to make an 83B election. You will pay tax on the value of that stock today, $10. Then your holding period for long-term capital gain starts. You have closed the compensation transaction. But let's say you decide, no, I don't know if I'm going to be here 3 years from now. So I don't want to pay tax on that because I might never get the stock because I might not fulfill my service requirement. So you don't make an 83B election. And 3 years from now, the stock is worth 25. Then you pay tax on 25, not on 10. So the upside of making an 83B election is if the stock appreciates a lot or appreciates at all, you're going to be able to have long-term capital gain. If you'd made an 83B election in my example, you would have had $10 of compensation income and $15 of capital gain when you sold the stock. If it was worth 25. If you didn't make an 83B election, restrictions lapsed, then you would pay tax on 25 ordinary income tax rates. The downside is if you pay tax on the 10 and you end up not working the 3 years as required or whatever the performance period isn't met, you don't get to give back. You don't get a refund of the tax that you paid. That's just gone.
So, Deb, it sounds as if that anybody engaging or an individual having these types of plans as an incentive, they also probably need a really good tax advisor to make important decisions with regard to, future potential capital gains versus ordinary income hitting the individual. Let me ask you this. What if the business owner doesn't want to issue additional shares or profits interest or anything like that? Are there, I think you mentioned one plan that allows an employer to give someone the feeling like they do have stock or stock ownership or an interest in the business without actually issuing additional shares or diluting the ownership of the company.
That's right. So we call those phantom shares. And basically, a phantom share is you get a promise to pay an amount equal to the value of the stock. But a phantom share can be almost anything. It could be an amount equal to the value of the stock, or I could just have a contract arrangement with my employees to say, I'm going to give you the 10% of the profits that we make this year. That would share in the value of the business, but really not have anything to do, or it would not be a transfer of equity. So you don't transfer ownership, rather you give a share of profits, and that's a deferred compensation arrangement or an annual bonus as a specific percentage of profits.
Understood. Yeah. And it seems like a business owner in either of the situations, the goal ends up being is to keep key employees and also cause them to even work harder to make the business grow so they can share in some of the growth of the company over time.
Yes. And if you do go with actually transferring stock, remember, in a private company, you can have a right of first refusal. You can have a call option. You can have put options. Put options, of course, let the employee put the stock back to the company, which could potentially put the company in cash bind. But all of those features can be built into these plans.
Okay, that sounds great. Well, we hear a lot of these next couple terms, and can you just provide some clarity on what's the difference between an ISO and an NSO?
Okay, so an ISO is an incentive stock option. An NSO, or some people call them NQSOs, is a non-qualified stock option. So an incentive stock option is an option which has more tax benefits than a non-qualified stock option, and it has more rules. There's limits on the amount that you can that become vested in any one period. That's probably the biggest rule. The $100,000 can be vested in any one period. The benefit of an ISO is that when the option is exercised, there's no compensation income recognized. So remember I said when you get stock, you pay tax on the value of the stock. Well, if you exercise an ISO, that taxation is deferred. You don't pay tax at exercise of an ISO unless you're in an alternative minimum tax situation. But then if you hold the stock received on exercise of an ISO for 2 years after you got the option and 1 year after you got the stock, and exercised it when you were an employee or 90 days after, and make those holding period requirements, the 1 year, 2 year holding period requirements, then you get capital gains on everything. If you don't meet the holding period requirements, then you have ordinary income. It just turns basically into a non-qualified stock option. And a non-qualified stock option is that you pay tax at exercise. And at that point, your capital gain starts running. So an ISO is really a better type of option for employees. Remember, the employer only gets a deduction for what the employees have put into compensation income. So for the employer, a non-qualified stock option provides a bigger tax deduction. But generally, it's the tax deduction of the individuals and not the employer that drive these options. And since 2004, all non-qualified and incentive stock options have had to have exercise prices equal to the fair market value of the stock on the date the option is granted, or in the case of a non-qualified stock option, become subject to 409 Cap A. 409 Cap A is a penalty tax situation, which most people do anything to avoid. So we don't see many discounted options. ISOs can never be discounted options. So their exercise price is always equal to the fair market value of the stock on the date the option is granted. if the ISO has an exercise price less than fair market value of the stock on the date the option is granted, then that is not an ISO. It's a non-qualified stock option, subject to tax when exercised, and perhaps subject to 409 Cap A.
Well, Deb, this is a lot of information, and I suspect that as you deal with clients that come to you regarding planning in this area, it sounds like there's just a lot of options that a business owner can put on the table for their key employees. So it's not a one size fits all. So this has been very good information. It's obviously a decision tree that business owners would have to make, from the most simplest type of benefit plan or incentive plan to the more complicated arrangements that they put in place. But clearly, I know you and I both see clients that have a variety of these various things that you've discussed with us today as part of their incentive plans. And I do appreciate you taking the time to give us a little summary of what you're seeing and what's out there. And I want to thank everybody for being on, joining us today. And we hope you found the podcast very beneficial. If you have any questions, please do not hesitate to reach out to us at cbh.com/PCS, Private Client Services Group. And please join us on future podcasts. And I hope you have a great rest of your day.